Impressive H1 results from the banking sector. The last two shows on the trading bell, we spoke to KCB and Standard Chartered Bank, of course, giving us a picture of the entire banking sector and how it's performing. Commendable indeed. Of course, we get to answer the questions of what it means to the sector in itself and at large to the economy. Of course, also to get to answer what is CBK doing in Parliament with the legislation for the digital lenders, and is this a competition or is it a collaboration? Of course, helping us to answer all these questions is the CEO Kenya Bankers Association, that is none other than Habil Olaka, and is right here. But let's take a look at his profile first.
Dr. Habil Olaka is the Chief Executive Officer of Kenya Bankers Association. He is responsible for the strategic direction of the association under guidance from the KBA Governing Council. Previously, he was the Director of Operations of the East African Development Bank EADB, based in Kampala, after serving as a resident manager in Kenya. He earlier served the bank as the Head of Risk Management and as the Chief Internal Auditor. He holds a Doctor of Business Administration from USIU Africa, a first-class honours BSc degree in Electrical Engineering from the University of Nairobi, and an MBA in Finance from the Manchester Business School in the UK. His PhD study was on the influence of strategic leadership on the implementation of strategy in the commercial banks in Kenya. He is a member of the Institute of the Certified Public Accountants of Kenya and the CFA Institute. He is an alumnus of the Strathmore School of Accountancy and has a good command of the French language.
Habil Olaka, welcome to the show. Many thanks for your time.
Thank you.
I'd like us to start the conversation. This is 2021. We are still in between the pandemic. From where you see it, looking through H1 and the results, very impressive indeed. What do you make out of it?
Yeah, thank you very much. I think it's difficult for us to look at 2021 without looking at 2020, because the 2021 is unfolding on the basis of what happened in 2020. And we know that 2020 was the year when the global economy was hit by the pandemic, and the banking sector in Kenya was equally affected. But fortunately, there was quite a bit of positive response from the regulator, from the National Treasury, and it created an environment where banks were enabled to be able to support the SMEs in particular that were really being ravaged by the COVID-19 in view of the containment measures that had been put in place. Yeah. So central bank come in, provide liquidity to the banks through the adjustment on the cash reserve ratio. We saw them, try to create an environment where banks could be able to restructure the loans to the SMEs. And at the end of the year, we saw the amount of restructured loans were almost 54% of the whole banking portfolio, which was quite significant. There was some liquidity that had been enabled, extended to the banks in the amount of 35.2 billion, most of which had actually been extended to the SMEs. So come the close of the year in 2020, we saw, for example, the credit growth had not grown as much as would have been expected, but in the circumstances, having achieved a growth in the first place was quite something commendable. But we also saw the NPLs, because at the beginning of the year, it was 12.5%, the NPL proportion of the total portfolio. By the close of the year, it was 14.5%, which is a significant increase, but nonetheless still contained within acceptable limits given what we were then going through. So back to your questions in terms of 2021, we are now seeing banks beginning to report their half-year performance for the first half of 2021. And what we are tending to see is some resilience from the banking sector, but also their push to support the economic recovery post the pandemic. Well, not quite post the pandemic, but in view of the recovery as we battle this pandemic and as we adjust ourselves to live with it, so to speak. So we have seen banks report some good results, and part of it is because of the fact that banks were fairly aggressive last year in compliance with IFRS 9, for example. So they took quite some significant hits in terms of the non-performing loans and the provisions that go with it. Now, given the the management of those particular facilities, a number of them actually have performed well. The loans that were advanced to these entities did not go into default. A number of them have been able to recover, and therefore they are meeting the obligations of the banks. So what most likely will going to happen is that as we go forward, a number of those provisions that had been written off will be written back, so to speak. So it will then be supporting the operations of the banks. And then also, the other thing is the fact that the business models of the banks have significantly changed, cutting down a significant portion of the costs that were being incurred, then becoming more efficient, pushing most of the transactions onto the mobile, onto the digital platforms, which means that the cost of facilitating those services to the consumers has significantly gone down. So you'll see the top line of the banks going up, the cost line going down or being maintained within the same levels as the previous periods, while building up the top line. And obviously, the profitability will be quite resilient and possibly going up as we move forward into 2021, 2022.
Excellent view there on the landscape of the banking sector, sir. But now, my follow-up question will be purely on sustainability. You know, considering, as you said again, we are still in the middle of the pandemic, do you see this being sustainable?
Yeah, I think one of the biggest strengths that we saw as banks crossed 2020 into 2021 were actually two things. One was the capital adequacy. Banks had significant capital adequacy, despite having taken in the significant provisions in 2020, they still were operating well above the regulatory levels for the capital adequacy. So, for example, the total capital adequacy was estimated at 19% at the end of the year, when the regulatory requirement was 14.5%, with fairly some good headroom. If you look at the liquidity of the banks, it was also quite well within comfortable limits. And this is partly because of the fact that the whole of last year, the deposit base in the banks did grow, but as we mentioned, the extension of credit did not grow as well. So most of that liquidity was being kept in treasury instruments. And that's now liquidity available for the banks to be able to on-lend going forward. So I think on those two very solid bases that the banks are sitting on, they're in a very good position to be able to support extension of credit to the productive sectors of the economy as we recover from the effects of the COVID-19.
Thank you indeed for that, and we hope that sustainability will be the game of the day. Now, we certainly need to learn how to live around it. This pandemic is really here, and we have to see how to go around. Let's move on to performance of loans, which is a key barometer on how the banking sector is really performing. Are we concerned about the current NPLs from where you sit, sir?
The NPLs are always a concern for the health of the banking sector. But it's interesting because at the beginning of the year, when COVID was declared a pandemic, we did do a survey amongst the members, and we're trying to gauge from them what would be the anticipated NPL level by the end of the year. That is the end of 2020. And incidentally, from the survey, they indicated that they expect the NPL level to rise from where we were at that point in time at 12.5% to 14% by the end of the year. Now, we were almost spot on at the end of the year, closing at 14.5%. Now, the estimation again, towards the end of this year, we are estimating that we will close at 15%. Now, that may look like a rise in the anticipated NPL, but given where we are coming from, there is quite a positive development because we moved from 12.5% at the beginning of 2020 to 14.5% at the end of 2020. And a marginal increase in 2021 is actually anticipated. And it's a sign of the fact that it's being reversed, given that we are recovering from the effects of the pandemic. And as I mentioned, a number of banks took quite a bit of significant provisions into their accounts, given the fact that they are complying with the IFRS 9. Now, what we are seeing is that a number of those accounts on which provisions were taken are actually turning out to be performing much better. They are recovering and therefore beginning to meet their obligations, and therefore the need to hold those significant amounts of provisions may no longer be required and therefore be reversed back into income. So as long as the situation remains as it is, and as long as we move into recovery, and as long as those accounts that had been non-performing begin to pick up and start performing, I think we are not worried about the development, the evolution of the NPLs going forward.
All right, we want to take a short break talking to Habil Olaka, CEO, Kenya Bankers Association, painting for us a picture of how the banking sector is doing. When we come back, we'll be speaking about the central bank rate and, of course, the digital lenders and what's happening in Parliament. Welcome back to the show. We are speaking to Habil Olaka, CEO, Kenya Bankers Association. And sir, I want to jump back to the conversation and ask you, we have seen a bit of relaxing of the credit rate in reference to the central bank lending rate. What has been the impact of this interest so far, and what's your observation with what CBK is offering?
Well, I think one of the things is the fact that central bank has, through the Monetary Policy Committee, has in a way maintained the central bank rate, which is the policy rate signal to the market at a fairly constant level. So it means that the signal being given to the market is the fact that there's stability in the macro environment. And despite all the shocks that are coming in, and despite the threats on inflation going up, I think central bank has done a commendable job in terms of retaining that rate at where it is, so enabling banks therefore to be able to extend credit that's affordable to the market, because the risk now is inflation beginning to edge upwards, and therefore the central bank rate also moving in sympathy with the inflation rate, and therefore the rates in the market beginning to go up. But I think central bank has kept quite a good control over that. So we expect, if everything remains as it is, the same stability to be retained in 2021, where credit will be within affordable limits for the borrowing community.
All right, many thanks for that. Now let's move on to credit uptake. And because of this pandemic, we have seen a slowdown in terms of credit uptake from investors. People were looking for money for business and the likes. So from where you see it, my question is this: what is the status now? Are we seeing a growing appetite?
Yeah, well, as we mentioned, the growth of credit in 2020 was estimated at 9%, 9.1%. Now, by the close of the year, there were a number of challenges that had been identified as the reasons why the credit may not have grown as quickly as was expected. And so a number of areas are being worked on as enablers to enable the flow of credit into the productive sectors of the economy. And one of them is the operations of the credit guarantee scheme, which is a scheme that has been put in place to enable SMEs access credit from the financial institutions by having a partial guarantee provided by the scheme to the lenders, who are mainly the banks, so to speak. In fact, this morning we've just been having a meeting with the National Treasury to see how to unlock, the flow, the operations of that scheme to enable credit to start flowing. It's already flowing, but there could be areas in which it can be hastened to move a little bit faster. The other one is the fact that a number of loans from the banking sector are actually collateralized on land, and there has been the modernization of the land registry in terms of what they call the National Land Information Management System, which is being digitized. Now, there has been a bit of a backlog in terms of transactions as we moved from the old manual system into the digitized environment. But that's now being unlocked because we had a meeting with the CS lands, and a number of the areas are being worked on to at least speed up the processing of those facilities. And that will unlock something close to 104 billion shillings worth of credit that's being held up through the process. The other one is the development of the risk-based pricing framework that is currently being developed between the banks and the central bank, so that then the appraisal of facilities and the pricing thereof will be based on the risk posture of the borrowing entity, rather than without some basis for determining the pricing. So I think once these are opened up and we're seeing quite a bit of progress being made, I don't see a problem in terms of unlocking the growth of credit flow into the productive sectors, especially in this period when you're trying to recover from the effects of the pandemic.
All right, and before we get to the end of this conversation, I would like to have a comment from you on asset allocation in the banking sector. How is it playing?
Yeah, I think the critical thing is the fact that we have seen, of course, a bit of a build-up in terms of the allocation that is going into the liquid assets in terms of treasury investments from the banking sector. So, like, for example, if you look at 2020, the growth in the deposit base was something close to 13%. The growth in the total assets was something close to 12.4%. But the growth in the credit facilities was, as we mentioned, 9.1%. What that means is that there was a growth in the total assets, which was not growth in the credit facilities, and that means that most of that therefore went into treasury investments. Now, hopefully, as we move into 2021, and as credit starts flowing into the productive sectors, we'll see a shift away from treasury investments, moving that liquidity into investing into the credit facilities that is supportive of the economic growth, rather than putting the money in safe treasury instruments that are not supportive of the productive economic activities.
Many thanks for that. And finally, we have seen the CBK has a bill in Parliament that seeks to have regulation on digital lenders. From where you see it, is this more of a competition or complementing role? And, how is this affecting the banking sector in general? I don't know, what's your comment on this?
I think it's a positive development in the sense that central bank is trying to create a level playing field for the players, and especially in the segment of the MSMEs for that matter, who are the ones that are tapping into the digital lending space. Now, a bit of the digital lenders were regulated and therefore are operating within some framework that is controlled. But then there were a number of digital lenders, especially the fintechs and the rest, who are extending credit, but in a very uncontrolled environment. And therefore, there is a tendency to have indiscipline. So, for example, even the pricing itself is way out of range, and it's difficult for the government to try to ensure that the consumer is not exploited. And therefore, trying to bring in some regulatory framework that comes under central bank is a way of trying to create a level playing field, so that players can play as per the given rules, and anybody who is not playing by the rules does not exploit the consumer, and therefore is kicked out of the playing field, effectively, so to speak.
And we certainly hope that good tidings will come out of it in a complementary role. Many thanks for your time, CEO Habil Olaka, that's Kenya Bankers Association, and we appreciate you for really helping us see how the banking sector is faring on, and commendable results indeed when we look through H1 results. Right about now, we have come to the end of the show, but of course, as usual, we want to leave you with the markets. And remember, you can always send in your comments and questions that you may have on the social media handles appearing at the bottom end of your screen. My name is Maina Shege. See you next time, same time, same place. Bye-bye.